Tesla is about to announce a new record delivery for Q1. The problem with this is everybody and their grandma already know it. Wall Street consensus is 419,000 deliveries, and Twitter analysts are around that same number as well, with Troy being at 423k and Gary Black being at 424k. But there's a bit of an overlooked metric that will prove to be much bigger surprise than deliveries, especially for Q1. I see a lot of people celebrating that China deliveries are gonna be very strong, but you gotta understand that Tesla just cut prices by 30% all around. Getting big numbers is to be expected. In fact, most investors are expecting full year deliveries to come around $1.8 million, which is 37% higher than last year. Now, despite that, analysts are expecting earnings to be the same as last year. Now, how can Tesla deliver almost 40% more cars and then make the same amount of earnings as last year? This, I believe, is the biggest opportunity for surprises this year. And that all comes down to a very sneaky metric called gross margins. And I've talked about it in this channel extensively, because I believe it's the best single thing that determines if a company has a competitive advantage. The reason analysts are so low on earnings is because gross margins are expected to come down a lot. And the reason for this is because of the price cuts. But the truth is, everybody's in the dark about this, because this is gonna be the first quarter that we actually take a look at margins after the big price cut that Tesla started back in December. And this will set the tone for the rest of the year. Now let's do something fun real quick. Let's find what kind of gross margins Tesla needs in order to beat analyst estimates for the full year of 2023. Since Q1 will have the worst profitability of the year because Texas and Berlin are ramping. That way we'll know if margins come higher than this number, we'll be in a really good position. Alright, so Tesla made 13.7 billion in profits last year, and we're expected to sell 1.8 million cars this year. Assuming energy and service revenues continue in the current trend, and we don't see any major margin improvements in those businesses, that's about $1 billion in gross profits, up from 400 million last year. So if we make, let's say, $7 million in safe credits, that adds up to $1.7 billion in non-auto profits. That means we need around $12 billion in auto profits to actually match last year's EPS at the very minimum. Using a linear regression, we can easily estimate R&D and OPEX at 4.5 billion and 5.5 billion respectively. And this is for the full year. So we'd need a minimum of 23% gross margins to actually match last year's earnings. Okay, but why do we care? Why does this even matter? Well, current Wall Street expectations for earnings imply 23% of gross margins. But if in Q1 margins come higher than that, that means that Q2 is going to be higher than Q1 and Q3 is going to be higher than Q2. And the reason for that is as we ramp Texas and Berlin, we're going to get better economies of scale. And we could very well see analysts having to increase their estimates over the full year 2023. And that will of course cause the stock to go up because Wall Street is not expecting any of this to happen. Now, what would happen if auto gross margins come below that 23% number? Well, that wouldn't be the end of the world because we still have the rest of the year to actually ramp up. But if it comes, let's just say below 20%, that'll be a bad time because we would have to spend the rest of the year actually trying to catch up to that 23%. And then analysts will be in line with reality. What we want is that analysts are offsides in one way or another. Now, I do expect Q1's free cash flow to actually come really strong regardless of what margins are. And this is quite the opposite to other OEMs, for example, Toyota. And we started seeing the cracks finally showing for the Japanese makers back in Q4. So if you enjoyed this breakdown, you're probably going to enjoy that video as well. Because the difference in free cash flow, I believe, is very important between Tesla and the other OEMs. But anyway, watch out for gross margins in Q1. And thank you very much for watching this video. I'll see you next time.